Have you ever thought that on one side of China, some highly polluting, low profit chemical plants are slowly exiting the stage under the pressure of environmental protection and industrial upgrading? On the other hand, in India, companies that produce similar products have seen their stock prices skyrocket, multiplying several times over in the past few years. This stark contrast between boom and bust is not simply a market fluctuation, nor is it some mysterious gift from China. Today, let's talk about the intricate connections between China and the surge in Indian chemical stocks. Act 1. The madness of Indian chemicals. Let's get a feel for just how crazy this Indian chemical craze really is. If we look at India's chemical indices, such as the Nifty India Select Chemicals Index, we will find that it has followed a very spectacular upward curve over the past few years. Of course, after reaching its peak in 2021 and 2022, this curve also experienced a significant pullback and fluctuation, indicating that this roller coaster ride was not all up and no down. When it comes to the company level, the story becomes even more interesting. Take Gujarat Fluorochemicals, India's leading fluorochemical company. For example, its stock price did indeed experience a remarkable surge between 2018 and 2022. Another company called Deepak Nitrite, a key player in the fine chemicals industry, also put on the dance of the elephant in the capital market, achieving rapid growth in both revenue and profit. However, like the index, they experienced significant performance fluctuations and stock price adjustments after that. Of course, this is just the tip of the iceberg. Faced with such a trend, any investor would ask, is this a huge bubble or a rediscovery of industry value? The answer is more complex than we thought, and many of the clues point to China. Act 2. The China factor. Pushing, not giving. India's chemical industry boom is largely the result of the combined effects of China's push and India's pull. Let's first talk about China's push. This is not China actively giving away opportunities, but rather a chain reaction brought about by a series of internal policies. The first driving force was China's environmental and safety storm. Over the past decade, China has taken unprecedented measures to combat environmental pollution, with the chemical industry naturally being a key focus. Chemical industrial parks have been established in various regions, resulting in the closure or merger of a large number of small and medium-sized enterprises that do not meet the standards. The peak of this crackdown was between 2016 and 2020. Now it's more about routine supervision. The direct consequence of this green revolution is that some low-end chemical production capacity with relatively backward technology and failing to meet environmental standards has been eliminated. This has led to a sudden supply gap in the global market for certain chemicals, such as some pesticides, pharmaceutical intermediates, and dyes. As global buyers search for alternative suppliers, some established Indian companies have found an opportunity. The second driving force is China's own industrial upgrading. China's manufacturing industry is transforming from large to strong. In the chemical industry, this means no longer frantically pursuing low value-added, high-polluting bulk chemicals, but instead concentrating resources on fine chemicals, specialty chemicals, and new materials with higher technological content. This is a strategic restructuring and upgrading. However, it should be noted that this does not mean China is abandoning the low and mid-range market. China remains one of the world's largest producers of basic chemicals. However, as Chinese companies strive to climb up the value chain, they do leave room for other countries in certain niche markets. The third driving force is the China Plus One strategy that we often hear about. In recent years, in order to diversify supply chain risks, many multinational companies have begun to restructure their procurement and production networks globally. Note that this does not mean leaving China, but rather finding a backup base outside of China. India, with its market size, cost advantages, and industrial base in certain sectors, naturally became a key target for investigation. Especially in the fields of pharmaceutical intermediates and agrochemicals, some Indian chemical companies have indeed secured substantial orders. Act 3. India's rally. Is it really ready? Of course, China's push alone is not enough. India itself must also be able to handle it. Why India of all places? First of all, the Indian government is indeed making a concerted effort. Policies like Make in India have created a favorable environment for domestic manufacturing including the chemical industry. Moreover, India already has a certain foundation and competitiveness in the fields of dyes, agrochemicals, and some pharmaceutical intermediates. Coupled with relatively cheap labor and a large pool of engineers, it is naturally quite attractive. But behind the opportunities lie equally enormous challenges. Is India's poor truly strong enough? The first and most critical concern is the dependence on upstream raw materials. An embarrassing reality is that many Indian chemical companies still heavily rely on importing key starting materials and intermediates from China. For example, in the fields of certain fiber intermediates and polymers, this creates a paradox. The more India expands its downstream operations, the deeper its dependence on China's upstream operations may become. This structural dependence is a major uncertainty hanging over India's chemical industry. The second challenge is the long-standing problem of infrastructure. Unstable power supply, congested transportation and logistics, and complex land issues have long been a pain point for India's manufacturing industry. Chemical production has extremely high requirements for the stability of energy and logistics. If these shortcomings are not addressed, it will severely limit the expansion potential and efficiency of India as chemical industry. Finally, there is the gap in technology and the scale. Although there have been breakthroughs in certain areas, overall, Indian chemical companies still lag behind leading Chinese companies in terms of production scale, process technology, and the completeness of the industrial chain. The economies of scale and the process optimization capabilities that Chinese companies have accumulated through long-term market competition are not so easily surpassed. Act 4. Investment lessons, goldmine or trap. Having understood this background, let's return to the question that investors care about most. Is the rise in Indian chemical stocks a genuine discovery of value or purely speculation based on expectations? First and foremost, it must be made clear that this is by no means a universally beneficial price increase feast where everyone wins a prize. The market is highly segmented. Leading companies like SRF and Nevin Flooring, which have core technologies, stable customers, and clear expansion plans, have indeed attracted capital investment. However, at the same time, many chemical companies have seen their stock prices perform poorly or even decline. This shows that investors are not fools. They are not blindly chasing the concept of Indian chemicals, but rather carefully selecting companies that are truly capable of taking orders and have long-term growth potential. Secondly, we must understand that the current stock price has largely already factored in the price of a bright future. The capital market is betting on India's future role in the global chemical industry. This means that stock prices have already reflected future growth. If subsequent order growth, capacity expansion, and profit realization fail to keep up with expectations, then the pressure for a stock price correction will be very high. So, as rational observers, what signals should we pay attention to? First, are the orders truly sustainable? Are those orders from China Plus One short-term emergency purchases or long-term strategic partnerships? This determines the sustainability of Indian companies' growth. Second, can the expansion plans be implemented? Many Indian companies have announced ambitious expansion plans, but whether these new capacities can be built and put into operation on time and within budget and achieve the expected efficiency and quality is a huge test. Third, can profit margins be maintained? Against the backdrop of fluctuating raw material prices and intensified global competition, whether Indian companies can pass on cost pressures and maintain healthy profit margins directly determines how much money they can ultimately earn. Overall, the rise of Indian chemical stocks is a complex story indirectly catalyzed by China's industrial upgrading and environmental policies, driven by the global supply chain restructuring trend and supported by India's own industrial base and policies. It's not a simple zero-sum game of who replaces whom, but rather a redivision and rebalancing of the global industrial chain. In this global drama, indirectly driven by China's industrial upgrading, who do you think will be the real winner? Will it be Chinese manufacturing, which has successfully moved towards the high end, or Indian companies, which have seized the window of opportunity? Feel free to leave your thoughts in the comment section. If you found this content helpful, don't forget to like and follow. See you next time.